One of the things I would tell my clients as these bad times persisted is the only way a manager could outperform its market's benchmark is to structure a portfolio that differs meaningfully from the market. This is sometimes called tracking error. If you're going to outperform something, you have to take bets that differ from the market index. Now, this period of underperformance was not because the manager was unskilled. At least that's what I would tell my clients. And in most cases, it was not a lack of skill. It was simply that their particular investment style was not being rewarded. Now, what do I mean by style? A style, in the beginning, I used to call them styles. And eventually, I began to realize these styles were something different. They were factors. Factors that drive performance. Things such as value, growth, momentum, low volatility. A value manager, for example, invests in stocks that are cheap relative to the market. And at times, these factors, such as value or momentum, earn an excess return above what could earn investing in the overall market. The market itself is a sum of what all investors own. So all the investors voluntarily own specific investments for whatever reasons, and the sum total of what they own, that's the market. And so the average investor owns the market because it's an aggregation what everybody owns. Consequently, the market is the most diversified portfolio an investor can own. It is the most efficient portfolio. That's what the market portfolio is. It is the most diversified portfolio, and it is a portfolio owned by the average investor. So if an individual or an investment manager wants to outperform the market, then they have to structure a portfolio that differs from the market. They can no longer be average. And if you're no longer average, then you're either above average or you're below average. And ideally, you're structuring a portfolio that differs from average that will allow you to be above average. One way to do that is to have factor exposure that has been persistently rewarded by the market. And we're going to talk about some of these factors, but momentum is an example, value is an example, low quality or high quality is an example, low volatility. These are factors that have persistently been rewarded that haven't been diversified away, and they deliver an excess return over the long term. Now, the question is, this excess returns are sometimes called risk premiums, and risk premiums are rewards for having factor exposure. And why do you get a reward for having a factor exposure? Because you are rewarded for suffering through bad times, periods of underperformance. Now, that seems like a bizarre concept. I'm going to be rewarded by suffering through periods of underperformance or bad times. Well, you can look at it as the overall market, this concept of the equity risk premium. Equity markets, the stock market overall, is heavily influenced by the growth of the economy. And when an economy is in a recession, stock markets tend to underperform bonds. Over the long term, so they're much more cyclical than bonds. They are less volatile than bonds, or more volatile than bonds. And so when you own stocks, there are periods such as 2008, 2009, 2001, 2002, when stocks dramatically underperform cash and fixed income. This is a bad time. Volatility spikes, performance drops, and that is a bad time. And that is rewarded. In other words, investors price stocks so that ultimately they are rewarded for those bad times. They get a premium, a risk premium. That's for the overall market. But there's also investable factors, if you step away, such as value, momentum, which also have periods of underperformance, bad times, and there's also a reward for suffering through them. But that's a rational explanation.